Debt payoff or financial freedom. This is the common mindset that many people have and why it stalls their progress. Hey, if you're new here, my name's Kristyn. I'm an authorized infinite banking practitioner. I help Canadian families and business owners reclaim control over their money, create financial peace, and live the abundant lives that they were meant to live by keeping more of their hard-earned dollars working for them. So one of the most common questions that I get that people really struggle with when we start looking at the infinite banking concept is whether they should pay off their debt first, then start infinite banking, or they have it in their mind that they can't start infinite banking because they're still in debt. So I want to really dive deep into this today. So a lot of people think once I'm debt free, then I'll start the plan. The problem with this is that waiting erodes your momentum. The interest keeps accumulating, cash flow remains tight, and life keeps happening. Unexpected car repairs, medical bills, life events like weddings, vacations, or maybe even just the opportunity to invest in another business. All of these events test your plan's resilience. And so we have to kind of reframe the way that we're thinking about debt. Debt payoff is a milestone, but it's not the finish line. The real win is having structure that preserves options and protects your cash flow along the way. So what is infinite banking? Well, it's not a get-rich-quick scheme. It's a disciplined way to use a specially designed dividend-paying whole life insurance policy as your personal banking system. The core idea is that your policy builds cash value that you can access with low-cost loans. When it's designed properly, you have access to cash up front through that cash value. You can use your cash value to finance your everyday needs, things like home improvements, education, business expenses, purchasing vehicles, without depleting your essential emergency fund. And you can keep the potential for growth inside the policy. Yes, you do pay interest on those loans, but it is staying within your own system. You can access the cash through loans. That's often, when you do it the way that I teach you to, you're not going to trigger taxes. The system is designed to support liquidity, protection, and future guaranteed growth. So why would we want to use infinite banking as part of your debt payoff plan rather than just paying off your debt first? Well, a comprehensive plan uses multiple interlocking pieces. Infinite banking isn't a silver bullet, it's a framework that stabilizes your cash flow, preserves options, and accelerates long-term wealth without sacrificing your day-to-day living. Here's how it works when you're working together. So we preserve your cash flow. With a banking system in place, you can access funds for emergencies or strategic investments instead of tapping into high interest loans and credit lines and outside financing like going through a bank. We can minimize the opportunity costs. So the money that would have been otherwise sent to a bank loan can stay in your system where it's going to compound and grow for the rest of your life without being interrupted. So here's how we would use your infinite banking system to help you and support you as you are trying to get out of debt. So first of all, we would want you to start saving in a vessel that you own and control. So you're going to start saving cash into your life insurance policy. Now, when we start a policy, you have access to a lot of the cash value up front. You don't have access to the full amount that you have put in. So this is not a system that's going to work if you are struggling with day-to-day debt. You're not able to manage your cash flow effectively. It may not be the strategy for you yet. We have to have some positive cash flow to be able to implement this system. The good news is once we can start using your system to take over some of these higher interest debts, we can start paying off the higher interest debts. And as we are paying it back into our own system, this is cash just like a line of credit that once it's paid down, you can use the cash again and again and again. The difference is your cash value inside of your policy is going to continue to grow every single day. So it's like having access to a credit line where the limit increases every single day. This does not mean that you should use this available credit every chance you get. This is part of a system that you need to be disciplined and use it to make it most effective for you. As we move the debt to your system, now you start repaying the same amounts that you would have paid to the bank. But because you're paying less interest inside of your policy loans, you are going to have a snowball effect where you're paying off more of the principal than you would have to that outside lender. Another benefit of starting your system sooner is we want to lock in insurability while you are young and healthy. So we do this through a number of different ways that we can keep your policy very flexible. We can put a minimum payment in place that is very comfortable for you and a maximum payment that's going to allow you to put more cash in as you gain more cash flow in your life because we're paying off these debts. So we really want to work up to that maximum cash flow, and we can even put other safeguards in so that you have more flexibility later on, so that we can add more insurance once you start getting these debts paid off and you have more cash flow. You can start adding more into your policies and we can make your policies bigger. So let's look at an example. So this is a concrete scenario that I hear from many families. They have a windfall come in, let's say $50,000 from an inheritance or a bonus, maybe a small business payout, anything like that. So the question that I get is, should I take the entire amount and throw it on my debt, or should I consider starting an infinite banking policy? Two paths, but the same goal: financial peace and more control over their money. Well, path A, we can use the windfall to pay off the debt. The pros, of course, it's an immediate payoff. It reduces the principal and you're obviously not going to pay interest on it. You have the psychological win of knowing that a chunk of your debt is gone, and it feels very freeing. The cons are that you still need liquidity for emergencies. Wiping out your cash reserves can backfire if you have an unexpected expense. And we all know that life happens. You're always going to have those unexpected expenses. And if you are in the habit of using credit to take care of those unexpected expenses, it's probably going to rack it up again. And this is the reason why many people stay stuck in that cycle and feel like all they do is pay off debt, and yet somehow it keeps rising. So if you don't begin infinite banking now, you're delaying the cash value growth that could happen later on, and you're risking not being able to be insured later on as well. So that's another thing that we want to make sure that we keep in the back of our minds. Path B. So let's say that we start a properly structured policy designed for infinite banking, and we keep some cash reserves for emergencies. The pro is your cash value is going to start growing immediately. You're also going to have immediate access to policy loans depending on the company we use. You retain liquidity to cover emergencies without tapping into higher interest debt. We can start moving some of your debt into policy loans, take care of the higher interest debts. We're still knocking off the high interest debts, and we're still going to pay them back over time, just like you would have if you hadn't received that windfall. The difference is the chunk that you've put into your policy is now going to continue to grow for the rest of your life. You create a reusable resource as you pay yourself back, not a bank. You're reducing the long-term interest that you would have paid to lenders, and you're going to put that money back into your own system. Of course, there's cons to this. There is upfront education. You have to learn about how this works, and you want to see long-term. You want to be looking at this as a long-term solution and not just a short-term win that's going to keep accumulating again. Some people might feel like they are delaying gratification by not wiping out the debt first. So just some things to consider when you're deciding which avenue to go. If your debt is high interest, like credit cards or personal loans, and you're already really restricted in your cash flow, you might want to prioritize reducing those balances first to regain monthly breathing room. We can still structure the windfall to fund both efforts. So we still want to put some cash into your policy, get that going. But if there's too much high interest debt, it may make sense to put a chunk of it on and have some of it grow. The important principle is that you do not want to leave yourself without liquidity. You want to have an emergency buffer, whether that it is cash available inside of your policy that you can access through policy loans for any emergencies that come up, or whether it's inside of something like a checking or savings account and having a small amount of buffer there too. So how would we implement this debt-free plan when we encompass both things together? So first thing is we would want to sit down and map out your current debt and your cash flow. We want to list all of the debts you have, the interest rates, your minimum payments, and your monthly take home. So what cash you actually have coming through your fingers every single month. We want to identify the leak points, so subscription renewals, unnecessary expenses, overhead expenses that you've kind of forgotten about. The next step would be to create a hybrid payoff plan. So we want to allocate a portion of your income towards going into a system where we are going to start saving your cash and it's going to start working for you. And we're going to leverage that towards the debt payoff schedule. We want to make sure that we're building our policy's cash value and future loan capacity together. So while we're doing this, we want to be rethinking the way that we think about money and start building a family banking mindset. We want to start using your policy as the place that you are storing cash, that you are paying off your debts to yourself because we love our families more than we love the banker down the street. And we want to reinvest the interest that we would have paid to the banks back into your own system of policies over time. Now, it's very important, like I said, that we maintain liquidity. We want to make sure that we still have an emergency fund, whether it is available cash value inside of our family banking system or whether it's cash that we can access outside of that. Some people like to use a HELOC as their emergency fund. Some people prefer to keep cash value. Either way, you want to have cash available to you if you need it for emergencies that come up so that you are not in a position where you have to go to the bank and get those high interest creditor loans. We want to make sure that we are looking at your plan every few months. We want to readjust. If things are happening faster, if we have more cash flow coming in, we want to make sure that we're allocating that properly and that we are paying off the highest interest and the most costly debts first before we start maybe accumulating for other things. Life changes, income grows, kids' needs shift. We want to rebalance your plan to maintain the debt payoff momentum while we're growing your cash value inside of your policies. So a couple things that I hear very often when people are starting to kind of understand how infinite banking works, they think that it's only for rich people or that it's risky. And the reality is that it's a disciplined long-term strategy that works across incomes when it's designed correctly. It's not about gambling in markets. It's guaranteed growth within a properly designed policy structure. People want to wait until their debt is paid off before they start their infinite banking system. The reality is you can start now with a design that respects your cash flow and keeps liquidity and accelerates your eventual payoff by preserving options. We want to have your cash as much as possible growing simultaneously while we are working on paying off these higher interest debts. And then finally, people think that infinite banking is an investment. The reality is it is not an investment. It complements investments with a debt payoff by giving you stable, accessible, and tax favorable tool that you own and control, and you can use it to your advantage to help you maximize your cash flow. Investments come after. Investments come when you have capital in your system that you can put to work in other places. But when we're working on a debt payment strategy, we want as much capital as possible to be growing for you and using that through leverage to be able to pay off these high interest loans and get as much of your debt accumulated inside of your own system so that you own and control it. So debt freedom isn't a single milestone. It's a system that you live inside. Infinite banking is a key piece of that system, especially for families who want liquidity, protection, and guaranteed growth without surrendering control to lenders. So if you're weighing a wayfall and you're not sure where to start, you don't have to choose one or the other. We can design a plan that reduces your debt while enabling your money to work harder for you inside of your own banking system. If you'd like a personalized walkthrough to see how infinite banking can fit into your debt freedom plans, I encourage you to book a no-pressure strategy session. We'll review your numbers, we'll walk through tailored examples just for you and show you how you can balance your payoff with policy growth so that you don't lose that momentum and you can keep your money working harder for you for the rest of your life. Thanks so much for watching. If you found this episode helpful, please give it a like and hit subscribe. When you're ready to take the next step, click the link in the description to access my free resources and book a call to start. Your future self will thank you. Until next time, live free.